Let's look at one more example of current liabilities. The unadjusted trial balance of the manufacturing equitable at December 31st, 2018, the end of its fiscal year, included the following account balances. Manufacturing's 2018 financial statements were issued on April 1st, 2019. So again, these balances are as of December 31st, 2018. We've got accounts receivable of $106,000, accounts payable of $50,600. We've got a bank notes payable of $696,000, and then a mortgage note payable of $1,250,000. Then it lists the other information. It says, number 1, required, prepare any necessary adjusting entries at December 31st, 2018 pertaining to each item A through D. So let's look through each item and determine, do I need to do an adjusting entry as of December 31st? So let's start with the first one. A bank note issued August 1st, 2018 are due on July 31st, 2019 and pay interest at a rate of 9% payable at maturity. So think about that. We have a note. It does accrue interest at 9%. Would we need to do an adjusting entry at the end of the period? Well, of course, because at that point we have accrued interest that we haven't paid yet from August 1st of 18 through December 31st of 2018. So what journal entry would we record? Well, again, this is a note, so we would accrue interest, and since we are the borrower, we would accrue interest expense on the note, and then we would need to credit interest payable because we're not actually paying the note at this point. We're simply accruing the interest on it. So the question becomes how much. So take just a moment, pause the video, and see if you can calculate how much interest. So to calculate interest here, we would actually take PERT as our formula, principal times rate times time. So PRT, PERT, principal times rate times time. We've got principal in this problem of $696,000. We would multiply that by our stated rate, which is 0.09, 9%, times time. In other words, how much time has passed since the inception through December 31st. And that would be 5 out of a possible 12 months, because it would be all of August, September, October, November, and December, so 5 months. So if we multiply that out, again, 696,000, we multiply that by 9% and then times 5 out of 12. And what we end up with is 26,100. That's the amount of interest that we would record on the note as of December 31st. Let's move to the next item. The mortgage note is due on March 1st, 2019, so that is a current note. Interest at 8% has been paid up to December 31st. So again, we've accrued all the interest. It's been paid because it is a mortgage note, so it probably pays at a period of time. So we've paid all the interest to December 31st. Assume 8% is a realistic rate. Manufacturing intended at December 31st to refinance the note on its due date with a new 10-year mortgage note. In fact, on March 1st, manufacturing paid $258,000 in cash on the principal balance and refinanced the remaining $992,000. So in this case, what entry do we need to make as of December 31st? Well, again, they give you that information not to make an entry because it says the interest is paid up through December 31st. So in this case, there would actually be no entry on this position. Well, why do we have all that information? It's to determine whether it's a current or a long term when we produce balance sheet. In essence, since it's due March 1st, it would be a current. However, since they have really high intentions and the knowledge came before we produced financial statements in April, we know that 992 of it, even though it's due on March 1st, would be long-term because we're planning to refinance that. So there's no adjusting entry, but the information is important for producing financial statements. All right, so next, we're going to look at the next one. All right, so C says included in the accounts receivable balance at December 31st, 2018 were 2 subsidiary accounts that had been overpaid and had credit balances totaling $18,700. So again, these are balances in the AR that were overpaid, which we shouldn't typically have a balance in accounts receivable, a credit balance in accounts receivable. The accounts were of 2 major customers who were expected to order more merchandise from manufacturing and apply the overpayments to those future purchases. So basically what has happened here is since they've overpaid, we've actually created deferred revenue. We've got items on our books that we owe our customers. So instead of carrying it as a credit in deferred revenue, we need to switch over and actually record it as a deferred revenue item. So how would we actually record that? Well, one, we need to go in and we need to get rid of the credit balance in accounts receivable. and it was for $18,700. And we need to reclassify that from accounts receivable over to our deferred revenue for $18,700. That shows that we owe these customers goods or services equal to $18,700. All right, and the last one. On November 1st, 2018, manufacturing rented a portion of its factory to a tenant for $27,600 per year, payable in advance. The payment for the 12 months ending October 31st was received as required and was credited to rent revenue. Now we've got a little bit of an issue here. So on November 1st, they rented a portion of its faculty to tenants for $27,600 per year, payable in advance. So basically from November 1st through November 1st, 2019. The payment for 12 months was received as required and was credited to rent revenue. So now, does this require an adjustment, or is everything okay? Think about that for just a moment. So all $27,600 was actually posted to rent revenue. Have we earned all of that revenue at this moment in time? First, we have to understand that not all of that's rent revenue. So this is a 12-month policy. Portions of this has not yet been earned. So what we need to do is take that $27,600 and divide it by 12. What that would give us is $2,300 per month. Now in that, how much have we earned versus how much have we not earned? Well, you can go either direction, but the easiest way is say, hey, we've earned 2, of the 12 months. So if we multiply that by 10 months still remaining, that equals $23,000. In other words, in rent revenue, we have $23,000 too much recognized because it hasn't been earned this period. So we do need to do an adjusting entry to remove that $23,000 out of rent revenue. So since they hit it in error, we're actually going to debit the rent revenue for $23,000. And then we're going to go ahead and credit our deferred revenue. And I'm going to stick this with deferred rent revenue just for the fun of it because it is slightly different from owing a service or a good. So we did transfer the in. Now, the offset of that, we could have reversed the full 27 in and then just recognized 2 months worth or $4,600. But since we've already booked it in error to the to rent revenue, it's easier just to fix the $23,000 versus reversing and then rebooking the amount. All right, so part 2 says prepare the current and long-term liability sections of the balance sheet. So on the current section, what we're going to do is first figure out what's current. Well, one, we know accounts payable is typically always current, so that's $50,600 there. Now, what other current liabilities do we have? Well, we did find a couple of things. One, we booked the interest payable, so we know that's going to be current because it's going to be paid off, and that was $26,100. And again, as long as you get all these, I'm not too worried about what order at this moment. And then, in addition, we have the deferred revenue. Now, you could do 2 separate items for deferred, but I'm going to combine them into one. So we have deferred rent and regular deferred revenue, so we got $23,000 plus $18,700, so that gives me $41,700 in rent revenue, or deferred revenue, not rent, but deferred. Then, what else do we have? Well, the thing that's left, we've got a notes payable, and we've got a current portion. So let's start with the bank note. All of that bank note will come due within 1 year of the balance sheet date. So the bank notes payable is going in fully as a current liability, $696. Now the last thing is the mortgage. So we've got to figure out which portion of this mortgage is current and which is long term. Well, the $1,250,000, it tells us they're going to make a payment of $258,000. So that's the current piece. Since they're going to refinance this, and they actually did prior to the financials being published, this piece would be long term. So the way we would indicate that on our balance sheet is, one, we would have the current portion of long-term debt, and that's going to be the $258,000, the portion we're going to pay. Then under long-term liabilities, we would actually show the remainder of that. So then we would have the actual mortgage payable, because we are going to refinance that, so it will be long term, and it would be the remaining of $992,000. So that's sort of a little bit about, based on these transactions, what our balance sheet for the liabilities would look like.